Banking Book Analytics Webinar Series 1, Liquidity Risk Management, Managing the Downside Risk, presented by BBA.
So let's start. My name is Paula Saad. I am Chief Commercial Officer at BankingBook Analytics. And why don't we start with some introductions. Andy, Suhal, can you please share a little bit about yourselves and maybe your role at BBA?
Perfect.
Go ahead, Suhal.
Thanks so much, Andy. Paula, can you hear me?
Yes, I can hear you.
Okay, perfect. Well, I've already brought up the slide deck on the screen. So my name is Sohail Farouk. I am Chief Executive Officer at BankingBook Analytics. My role essentially is working with my team to develop the content and to create implementation of our projects. I also work very, very closely with Paula and Andy on the business development side. With regards to BankingBook Analytics, I would briefly introduce the firm. So if you were to actually jump over to slide number 5, we are a data-driven solutions company, and we've developed a data analytics platform that allows our clients to focus on 2 important things. The first and foremost is preservation of capital, and the second is essentially around profitability enhancement. And we do that by developing analytics around the balance sheet, around proactive customer behavior, and forecasting the profitability. In order for us to actually facilitate the clients, we've developed a range of applications, which includes essentially the Scenario Frontier, a key product from a topical perspective, and this is something that we would be discussing with regards to the stress testing and the role that Scenario Frontier can play. The other one is economic capital management product. So it is essentially around through the cycle management of capital. So it does not take into account the cyclicality of the economy. And then the second cohort is around predictive consumer behavior. So, we're looking at products which would actually allow management of prepayment behavior from mortgage companies' perspective, credit stream, retail edge, and so forth. So, and the final piece is that we also provide advisory around the topics which are of importance, such as cyber, regulatory compliance, pricing and profitability, and so forth. Over to you, Andy.
Well, thank you, Sohail, and it's a pleasure to be with everyone this afternoon. I hope you're all well and healthy. Sohail's mentioned in the slides there, I'm a senior advisor to BBA. I've got probably about 30 or I guess 38, 40 years of experience in financial services, both in management and then at the regulatory level with both the federal and provincial levels in Ontario and with OSFI. And my background essentially leads me to help out in those areas where regulatory compliance and risk management are of value to organizations that need our help. And I'm happy to support Sohail and his team. So that's it for me. Thanks. I see Barry's there. Hi, Barry.
There you go. Over to you, Suhal.
Okay, perfect. So essentially, I'll kick off from the slide number 2. This is part of our ongoing webinar series that we've organized for 2020. So today we're going to talk about liquidity risk management, managing the downside risk. So when we were structuring the topics for the webinars, there was no COVID-19 on the horizon. Some of these topics may or may not really be relevant or have potentially become extremely relevant. But that being said, we've kept the slot open for webinar number 4. And please feel free to email the topic of your interest. And once we have a topic, we would make that announcement. But for webinar number 2, our focus would be around going digital, the credit union transformation roadmap. in which we would talk in detail with regards to the ongoing digitization efforts, how to facilitate the employees' work from home infrastructure, and how to facilitate the delivery of services, including performance of the point of sale and branches and so forth. So that would be covered in Going Digital, the CU Transformation Roadmap. The third webinar would be around enhancing the profitability at credit unions. Like I said, this was set up prior to COVID-19. So I'm sure there would be interesting dimension now to this particular topic with regards to the profitability and understanding how resilience can enhance the profitability at credit unions. So over to you, Paula.
Thank you everyone again for being here. By staying some housekeeping items, by staying in this webinar, you agreed that it's being recorded, and also you're going to have a link to watch it later, or share with your colleagues if you like. And the information, data, and approaches provided herein are an outcome of our research and content expertise, although we may refer to third-party materials and or analyze the impact. The content is the outcome of BankingBook Analytics, proprietary knowledge, and is rightfully owned by us. This work is copyright protected and legally privileged. BBA has made an best effort to ensure this material is complete in its entirety. However, we do not warrant its completeness, accuracy, uselessness, and satisfactions. Please email the questions at my email at paola@bba.to, and also via the chat, and that's it for now.
Maybe Paula, because we have a limited number of people on the webinar today, we can ask people if they have a question just to take themselves off mute and ask the question as we go along. It might be more efficient that way, so I'm okay with that if that's okay with you.
That works for me totally. Yes.
Essentially, the outline for today's webinar is we'll have the brief introduction of firm that has already been made. We'll do a little bit of deep dive and identify how COVID-19 has disrupted the macroeconomic situation across the province, nationally, and globally. Then we will talk a little bit about how do we incorporate or implement the impact of these macroeconomic factors on our portfolios. There would be a few slides around the illustrative impact, which could potentially be around the key risks that the organization have, with more emphasis on liquidity risk. And the final piece is what kind of management tactics are available with regards to coming out of improving the resilience and coming out of this scenario stronger. Thank you.
Okay, so trying to think about, Andy, trying to think about the rate of the government's playing, the role the government's playing in stabilizing the overall economy, equity, and capital markets. Give us your thoughts and how Canada is doing.
So I think it's fair to say that this is a once-in-a-lifetime event that we're experiencing here. And what we've been able to assess in terms of what it looks like before and after the pandemic is a lot of it is to some extent speculation about how it's going to look. We're still in the early stages, and if our previous experience with pandemics in 1918, which is now over 100 years ago, is any indication, it's going to be a lot of changes both in economics and society, and we all know that, so we're not going to get into a lot of detail on this, but the reality of it is that the structure of our businesses, all of them are going to change. The severity and the timeline of the pandemic, this wave of it, because it's expected to have more waves coming forward, is going to have a significant impact on both equity and credit markets. And so from the macro experience so far, a lot of federal and provincial money is going to be flowing into the economy, which of course is going to have impact on the fiscal and to some extent monetary situation. I think it's fair to say we will expect a long period of low interest rates, for a whole bunch of reasons, and I think we can all sort of understand what those reasons are going to be. And then, of course, on the business side, there's going to be all kinds of issues with respect to supply chain, which we've already seen in some cases, and customer service and customer retail service in particular is going to be totally revamped, I think. And I was just having this conversation this morning with somebody. We've probably advanced the whole digital disruption regime by 5 to 7 years.
Mm-hmm.
Things that we expected to happen 5 to 7 years from now are happening as we speak today. There's also going to be there was some indifference to asset acquisition in the past. The question now becomes, what happens to real estate? What happens to healthcare? How about logistics? What are data centers going to look like going forward? How big are they going to be? Actually, I'm personally quite surprised that the infrastructure of the entire network, the digital network, has held up as well as it has, with all these people working from home and from other places that they normally work. Certainly, the workplace environment is going to change. And finally, I think that the big thing for me, for financial services companies, and credit unions in particular, and small banks and even the larger banks, is that where everybody was concerned about profitability and sustainability before this pandemic hit, there's real big questions about liquidity going forward. And so far, again, I think the government response and the response of financial institutions has been largely positive. And I think the liquidity scenario at the moment looked pretty good, but I think there's going to be some challenges going forward. So for sure, things are going to change significantly as we go through this. I think it's going to be an uneven road. We'll talk a little bit about the macroeconomic scenario in a moment, but I think it's going to be a very challenging environment. So perhaps we could move on.
So Andy, you mentioned that interest rates are lower, and of course, this penalizes savers and also investors, move up the risk chain to find returns. Do we need to worry about the low rates, about the impact that will have on the prices?
Well, low interest rates have got some interesting dynamics to them. We've already experienced that for quite some time, and of course, for financial services companies, especially deposit-taking institutions, low interest rates can mean compression of the financial spreads and margins, and that puts a tremendous amount of emphasis on other revenues. And I think we'll see more of that going forward. The initial indications so far in the marketplace is that while those lowering interest rates have not had a significant impact on the financial margin at the moment, the competition for deposits and the competition for liquidity is going to continue. So I think we're going to see some more activity there and some more discipline around that going forward. It'll be interesting to watch, and I think it's going to be very important to do some, and we'll talk about this in a little bit, some stress testing and some really thoughtful exercises around scenario planning.
Great. This is my question for Suhail. Suhail, we're going through unprecedented disruption and market volatility. What tools are potentially available to the management to manage extreme volatility such as this?
Well, thanks, Paula. I think first and foremost, I'd like to actually resonate what Andy just described. We need to approach this crisis with some humility. So although the government support has been unprecedented, there is also monetary stimulus in the form of lower rates. The credit and equity markets have been functioning rather normally. In fact, if you were to actually look at it year over year, performance of TSX, the current performance is rather above what it was a year ago. So it has, of course, been doing very well. But that being said, there are several looming questions that we need to be able to understand. The first and foremost is, to what extent the government support will remain in place? The second is, will the government allow market forces to determine the winners and losers coming out of this crisis. And of course, the key question that we need to understand from the perspective of our preparedness and the tactics that are available for the management is that although we are in a rather well-cushioned situation, but the lasting impact of this situation could have some disruption at the other end of it. So coming out of this disruption or this crisis, we need to understand where we are today and what would be the likely outcomes associated over the next 2 to 3 years. So just to set the context here, we are looking at a drop of over 4% in GDP for Ontario and also for Canada. Now, before the crisis set off, the markets were already factoring in the recession or recessionary environment. And as a result, there was some level of preparedness, and the institutions were getting themselves organized to meet those unforeseen recessionary situation. But that being said, it has worked out in the favor of those institutions who were actually organizing themselves to be able to factor in the impact of the recession. But that being said, as Andy mentioned, this crisis is once in 100-year or over 100-year event. And this is unprecedented, clearly a black swan, and nobody had forecast a over 4% drop in the GDP. So we need to understand where the recovery is going to come from, how it would look like, and how are the organizations, financial institutions, including credit unions, are going to prepare themselves should there be a crisis. Okay. So talking about the recovery, the first and foremost is that once we are at a point where the health remedy, be it in the form of a vaccine or a wellness therapy, becomes available, the question that becomes that before it hits the normal, would it be prepared for over 7 billion people so that they're all vaccinated? Or would it be done in stages? So clearly the timeline of having a scenario where over 7 billion people are vaccinated or are able to move around freely is challenging. So we are looking at some options here from, and these are really from the economists. This recovery could look very much like a steep ascent to the normal situation, or it could be a rather long and drawn-out crawl out of the crisis, or it could be a zigzag, what is now being called a W-shaped recovery. So one crisis can be correlated or coupled with another crisis. Some of the options that folks are talking about is essentially the second wave or the food scarcity, because a large swath of land is actually under the locust attack, especially in Africa and parts of Asia. So that could be another crisis from looking at it from a systemic or external sources perspective. So clearly there are some considerations that the management need to take into account before they can start planning things out.
It's Andy here. One comment, but and that is that it's possible that the recovery looks like a W-shaped many times over, depending on the number of various waves of this virus attacking, plus all the other things that are going on that are concurrent. So it may be that we have a series of events carrying forward. I just described some issues with respect to supply of food, transportation, other sort of parts of the economy that will be impacted by these events, may in fact be impacted and then ultimately re-impact the economy and the financial services marketplace. So it's going to be I think an interesting bumpy road for the next I would say at least 18 to 24 months. Thanks.
Good. So once we have, of course, an understanding of the current situation, as we mentioned earlier, the GDP is projected to decline by over 4% year-over-year basis. the mortgage rates have remained rather steady. There's a chance that some businesses would become unsustainable as a result of COVID and would probably be faced with large maturing liabilities, and hence they may have to either declare bankruptcy or bankruptcy protection. So that would have an impact on unemployment. So we're looking at rising unemployment. Similarly, we've seen historic volatility within the equity markets, although the credit markets have been doing quite well up until now, and there is apparently excess liquidity. But the volatility in equity market could stay. Similarly, as the rates are low, apparently the inflation is expected to be low. There is also chatter of deflation. So in other words, there is more money chasing the assets, and that could really sort of also taper down the investors' confidence, and hence their ability to invest in the in productive equipment. So that also can be factored in. Similarly, the impact of reducing sales for the residential housing can also lead to lower housing starts. And so all these sort of factors kind of combine together to give us an idea or a sense that how the economy is going to behave towards the end of 2020, as we're already almost wrapping up the month of May. With 7 more months to go. So a lot of this forecast is already baked in 2020 projections. So the question then becomes, how would 2021 and 2022 look like, and how do we actually plan things out? So that is really anyone's guess. As I said, there are several unknowns, and we need to be able to take a cautious approach. Yes, if we were to look at, say, a W or several zigzags or many Ws, there is expected recovery. Similarly, the rates are likely to be affected, and we're already seeing some basis point reduction in a 5-year mortgage rate. There could be reduction in unemployment, and so forth. So all these factors have a combined effect on our sensation with regards to the direction of the business and the direction of the economy. Okay, so just to give you an idea that when we are trying to plot a forecast from a macroeconomic perspective, all factors do not move with either equal speed, nor do they move with equal sort of weight or direction. So for example, if the GDP drops, the rate is expected to actually, the mortgage rate or lending rate is expected to drop as well, and that essentially means that there is a chance that, the prices can go up as the consumer demand rises. Similarly, the unemployment can have an impact and so forth. So what this radar graph does for you is really shows you how each one of these factors moves, and relative to the movement of that factor, how the offsetting or compensating factor moves to be able to support the fiscal as well as the monetary policies. So drawing further on the stress case, what we're trying to project here, that as we already know that 2020, most of the projections are already baked in, but how would it look like if the recovery were to slow down significantly? So that is really a challenge for us. So for that, we need to look at 2021. So essentially looking at the growth of GDP, say to 4%, and in 2021, we're looking at it much less than 4%, so around 3.5 to 3.8%, which is the sort of course, not the base case, but rather the stress case. As we all know, prepare for the war, but pray for the best. And from the perspective of preparing for the war, we need to be able to understand the adverse case, and similarly, a severely adverse case that can have an impact from the perspective of macroeconomic situation on the institution's balance sheet and income statement. So this is a further visualization of, say, slowing down of the recovery. So as you can notice that the base case is given by the green line here, and the orange line represents the stress case. So the decline or the steepness of decline in the stress case, pardon me, reflects really the depth of the recession that it can potentially hit. And similarly, as you can see, that the slowdown in recovery stretches this recovery out to sort of late 2021 or early 2021 versus a projected recovery of late 2020 or early 2021. So that has an impact from the perspective of strategic planning and deploying management tactics to be able to offset the negative impact of such a decline on the institution's performance. Similarly, if you were to actually look at the projected movement around 2022, you would notice that the second V of the W emerges. But that being said, around the stress test, we can notice that it is slightly less tapered. In other words, there is resilience in recovery, and it is not vulnerable to second wave, as it is slower paced and well thought out recovery. So this is really a picture for one key factor, which is the GDP. You can consider many other factors which would be really plausible from your institution's sort of correlation with macroeconomic indicators, and hence can be used as indicators, lead indicators, to determine the impact on your assets and the balance sheet.
So, I have a question, if I could just pose as you were speaking. I was thinking about this. I gather, I guess, to some extent, the regional differences in recovery would also have an impact on these kinds of scenarios, right?
Exactly. So, the regional idiosyncrasies or specifications, would have an impact. So, for example, if a certain province or a certain state in the U.S. is well endowed with technological assets or technological platforms, the speed of their recovery or perhaps the impact of the recession might be rather muted compared to those which are focused primarily on entertainment assets, such as a good example is Nevada. Of course, that would make sense and has to be taken into consideration.
Great, thanks.
You're welcome. Okay, so moving on and just building on Paula's initial question. So what kind of framework can we use really to model the impact of macroeconomic conditions on our portfolios? As we said earlier, looking at the factors that have shown relevance from your business's perspective is an important part of it. We said when you prepare for war, you pray for the best, but you do have to prepare for yourself, prepare for the war. So adverse scenario or a base scenario, which ideally reflects the current situation, which is, of course, once in 100-year event. So clearly a black swan base case from our perspective, and the variation or permutation of that base case can be in the form of a stress case or adversely stress case. So once you have those modeled or those numbers crunched, you can then look at their impact on the defaults. You can look at their impact on the recoveries, and you can also model the sort of the secondary scenarios coming out of that modeling with regards to the impact on capital, expected credit losses, and of course the knock-on effects that they would have. So all of that can be encapsulated in a loan distribution curve, which is shown on the right of the screen. So here we are showing that as a result of disruption emanating from these sources, we can create a model that would allow us to understand the impact of this disruption on the portfolios with regards to the defaults and recoveries, as well as on the profitability with regards to the impact on the earnings. So this is a well thought out model. The approach is known as Merton's approach, which basically works using transformation factors and so forth. As I said at the start of the conversation, BBA's Scenario Frontier actually provides you with the ability to undertake such modeling. Any questions? Okay, so now we are at a very interesting stage, because here what we want to do is essentially provides an indicative impact. All things being equal, what if there is no government support? Or what if there is limited government support, which is not covering the entire spectrum of all sectors in the economy? What would be the default rate situation? What would be the recoveries associated with those defaults? So looking at it from really a top-down perspective, in the absence of government support, uh, we're looking at a default rate spiking up from, say, below 1% to 15 to 18% across different portfolios. And as I said earlier, and Andy mentioned, that certain asset classes that have become preferred versus some of the other asset classes that are less lucrative post COVID-19 are expected to experience higher default rates. Now, of course, with government's help and the stimulus and the bridge that the government is providing, this could very well get muted. But we need to be able to understand that as soon as the government support diminishes or reduces, such defaults could start becoming more pronounced. So that's the thought around here. Across the board, with the exception of residential mortgages, we're looking at potentially higher default rates.
I think if I could add, Sahil, to your point, I think the issue is not going to be how much support. It's going to be how long will that support be sustainable by the government, and which areas of the economy is the government going to continue to support even now, and what does it mean for the other areas of the economy that credit unions and other financial services companies might be exposed to. And I think it's going to be a very interesting, sort of perspective on how it all looks going forward. We already know that the government this time around, unlike 2008, where they bailed out companies, are more interested in bailing out individuals. Completely different response by the policymakers from 2008, 2009. So it'll be interesting to see how, if any, of that comes through a sector by sector basis, which will have some significant impacts on the credit portfolios of financial institutions in particular. Thanks.
Exactly. So yeah, no, frankly, I mean, it is unknowable with regards to the impact of the crisis on the portfolios. But that being said, such planning and modeling would allow us to develop deeper insights from the point of view of having the data available, having the analytics available, and be able to actually create the contingency plans to remedy or mitigate such risks if they were to occur. Perfect. Paula, over to you.
So we're looking at the action plan now, and are you going to speak on that, Suhail?
Yeah, perfect. So as we said earlier, we do think, frankly, it is unknowable. So we have to come up with a bit of a creative solution with regards to understanding that what it comes down to is when we would have either the vaccine or a life-saving therapy, and whether or not we would be preparing the 7 billion doses that we need so that we can act and function normally, or we're going to work through this period of bridge, which can potentially stretch, say, 4 to 5 years before herd immunity the concept kicks in, or even the vaccine is available. And what would happen during this intervening period of 5 years? Would the government continue to support, or would there be limited support and perhaps starts tapering off after a certain period of time? So in order to counter that, we need to understand where we are in terms of the current situation, prepare for the war, and then develop an action plan, which would allow us to really test the resiliency of our business plan and put in place adequate resources to mitigate those risks. So it's a very important part of the entire journey. And looking at vulnerability with regards to the stresses that we just discussed, and those stresses are in the form of higher defaults, those stresses are in the form of reduced recovery rates. Similarly, can also include, say, counterparty defaults and so forth. So those vulnerability can potentially creep in and challenge the organization's sustainability. So clearly, the next step is we need to look at the business structures which we need to develop and look at the resiliency of our strategy, the financial planning, and the risk management process. So not just that, and we also need to determine what is the scenario transformation or transmission mechanism that exists within our organization, and what could be the knock-on or secondary scenarios that can emerge. So this is indeed a huge checklist that needs to be looked at, and then the impact of this checklist need to be translated into the key risk types. The second important part here is to understand, once we have the checklist in place, we've identified the vulnerabilities, we then need to determine how these vulnerabilities or inherent risks can be mitigated so that, you know, controls can be effectively put in place. And quite frankly, there could be areas where there might not just be any control pre-existing as a result of a rather benign environment that we were in. And we may need to actually either structure completely new controls, or we may need to modify our existing controls. So that's the second part of this action plan. And the third is really around management tactics. So that essentially implies that what if these probabilities were to actually materialize from a vulnerability perspective, what kind of impact they would have, and what kind of mitigation plans do we have in place from the perspective of developing overcoming the contingent risk or the event risk. And of course, that all should come in the form of reporting and packaging so that, you know, such information is shared with all the key stakeholders.
You know, so Sohail, it's Andy here. It's interesting because on the boards that I serve on at the moment, we're still sort of in the vulnerability assessment process. Some leakage into the controls planning, and you know, it's not sequential. We're finding now that that we've seen what we're experiencing. So we're doing a little bit of vulnerability assessment. As we find those vulnerabilities, we're doing some controls and some implementing some new controls and new areas of training, for example, and support and learning and feedback. And then we're still slowly getting into this idea of, okay, what do we do now? How do we recover from this? So as an example, it's a non-financial services company, but it's a long-term care facility, which has been under tremendous stress lately. I serve as a chair on that board, and we've done a little bit of these things, these three stages that you've described them already. And we're trying to figure out, going back and forth, actually, between vulnerability assessment controls and then tactics to address them. We're going back and forth as we learn and as things evolve. So this is a very useful model, I find, and I think it's very reflective of what's actually happening on the ground. So thanks.
Yeah, thank you so much, Andy. And I do think this is this process cannot be perfected in its first instance, and of course requires a lot of iteration. But yes, you know, if done professionally, these iterations can be significantly reduced. Okay. So with all that in place, we understand that we need to have an action plan in place which would address the downside risk. But at the same time, the knock-on effect is really on liquidity of financial institutions. So within that context, for each scenario that we would design, we need to be able to measure the requirements from liquidity's perspective and understand what sources would be available. So that is really when we talk about the contingent planning and ability to sort of look at our asset classes and then determine sort of the rate sensitivity of those asset classes, the duration of those asset classes, as well as on the liability side of it. What is important is that we develop sources and uses and the gap analysis from liquidity's perspective under each scenario. Okay. So the final piece is that once we have the sources available, we need to recognize and appreciate that some sources or some scenarios might have varied sources available compared to the others, and all of that is really a function of how the scenarios are understood to be at the organization's level from a vulnerability perspective, and then from the management tactics perspective. So this brings us to really an interesting slide where we want to be able to see that how would it cascade for each risk type, and what would be the key vulnerabilities. And as Andy's mentioned, being chair of the board, you're looking at top-down perspective, but here the exercise becomes around both a top-down and bottom-up. So essentially, we need to be able to understand that what is our headline credit risk appetite, and how does that percolate through the entire portfolio across retail, commercial, and wholesale, and then try and determine the relative impact that each one of these have with regards to a bottom-up understanding of the portfolio and its vulnerabilities. Similarly, so for example, on the credit side, some of the key issues that can be immediately looked at are around the performance of different asset classes. We talked about some asset classes becoming more favorable than some of the other asset classes. So, for example, community living is becoming less favorable. High population living is becoming more challenging to be able to manage it against the COVID-19 risk. Similarly, entertainment assets are less attractive, but logistical assets are becoming more favorable, and similarly, technology assets. So try to understand an ability to map the industries of your portfolio, and then looking at the large exposures is a great starting point. And even better, if you want to look at, say, your commitment levels and try and attrition those commitment levels. Similarly, for those institutions which are in syndicated lending, they need to be able to understand from the syndication market what is the rate environment out there. Is our institution still providing or following up on their commitments, or are they reducing the commitments? And that sort of early warning should allow institutions to be able to organize the performance of different assets and put in place different measures. Similarly, canceling the undrawn lines could be another example where institutions can identify that if lines are not wanted or not warranted, they can be canceled.
I think so. Here, if I could add, if I could add to your comment, I think this concept of how has the risk appetite of organizations changed as a result of this is very applicable to the conversations that directors and management are having at the moment. Mm-hmm. There's two options. It's more than two options, but there's one option is to leave it as it is, see how things work out. And the other one, of course, is to retrench and revisit the risk appetite given the circumstances. And I think a lot of organizations at the governance level, financial institutions and others are going to be going through that conversation if they haven't already done so. So I think that's a very important point.
Absolutely, absolutely. Similarly, looking at the market risk, the key concept here is around the valuations and the cash flow. Similarly, if there is a volatility in the marketplace and your assets on the investment side are indexed with the equity or credit markets, then the potential is that you should be able to determine to what extent that volatility is acceptable and how it can potentially eat away the capital, because when your value at risk sort of starts going up at a certain confidence interval, you may want to be able to understand the sort of ongoing impact of such capitalization. Looking at the operational risk, so as the cost, infrastructure-related costs are going to go up with employees working from home, the challenges start creeping up around cyber risk and the impact of cyber risk attacks on the organization. Of course, the controls become rather limited. There's more discretion at the hands of the employees. Similarly, there could be several other scenarios that can be looked into to be able to determine that how the operational risk side can play into the vulnerability risk of the from an institutional perspective. On the liquidity side, we need to look at the liability side of the balance sheet, as Andy's mentioned and Paula mentioned at the beginning of her comment. More money chasing higher yields. Depositors need products which would guarantee certain return. They need to be able to entice into the rollovers so that there is longer term maturities available on the liability side, and also looking at the concentration of the deposits and identifying what are the top 10 deposits on the balance sheet and how they're being managed is an important aspect of it. For those organizations that rely on securitization from wholesale funding perspective, that is another market that they need to look at. And some of the things they can look at would be the differential of the swap rates relative to the treasuries and so forth, so that they can understand the risk of the counterparties and how the counterparties' risk is being perceived by the marketplace. So as that spread increases, of course, the challenges with counterparties become more and more evident. And similarly, the taps with regards to the warehousing of the loans that would be securitized in the future have to be kept under control. Potentially, a scenario could be that when and if the markets do get dislocated, what would be the sort of attribution of those assets? Also need to look at the off-balance sheet structure of it. So if you recall, in 2008, AIG's biggest crisis came in the form of the credit default swap that they were guaranteeing, and which was really sitting on the off-balance sheet side of it, but essentially ballooned into a larger liability, which was even bigger than the balance sheet that they were holding. So we need to be able to look at all of these aspects and be able to start building up a case around the vulnerabilities. Any comment that Andy you might want to add? Otherwise, I think the list can be developed, which would allow key stakeholders in the management team to be able to take it to the board and determine what controls they can develop from vulnerability perspective.
Thanks. Go ahead.
No, go ahead, please.
So the only comment I was going to add would be that obviously the regulators are also looking at these risk areas, and they may be focusing on one or the other. In OSFI's case, they've provided some relief on the credit risk aspect of it. They haven't really spoken too much about other risks yet, and certainly on the liquidity risk, which is the one that I think we will all focus on, at least in the short term, they haven't prescribed anything. I'm not sure if the provincial regulators have said anything on any of these risks as yet. I'm pretty sure that they're strictly just monitoring the situation. But I think you'll see perhaps some tweaking on the regulatory side over the next 6 to 9 months as they work through the impact of the pandemic situation. Thanks.
Absolutely, Andy. And I think to your point, what I would like to do is perhaps build a little bit that, the kind of support available to the big 5 banks, with regards to liquidity windows at Bank of Canada and so forth. What is the current situation with regards to the large credit unions? Is there similar support that is being made available, or efforts being made to be able to provide the kind of support that they need, in addition to, of course, a review of the regulatory ratios and so forth?
Well, I'm not aware of any significant changes in the regulatory structure given what's going on, but I invite Barry, if Barry has any comments, he's on the line, if he could maybe contribute anything he knows about anything specific.
Thanks, Andy. C1's Central One has been working with the Bank of Canada, done a couple transactions with one of their, and I forget which line, short-term money. So that is happening at the Ontario level. Both the, I think, FISRA and the large credit unions are having discussions with Bank of Canada, or to see whether credit unions can tap into some of the Bank of Canada programs directly. And there's also conversations happening with the Ministry of Finance to have, if the Bank of Canada options do not come out or don't come out to fruition, then they're having discussions with the Ministry of Finance around stepping in where Bank of Canada steps in for banks under certain circumstances. FSRA always has said that what's available to the credit unions is also the DERF could be used. So that's the deposit reserve fund. And they also have a line of credit that may be used. Now, you add those two things up, it's not really material if we get into a critical situation. That's about an update on in Ontario where the unions stand.
Well, thanks, Barry. Yeah. Through its deposit insurance fund and its access to a line of credit with the government does have some scope there, but it would be, as you suggested, very limited if it was a systemic issue. So I think everybody on the regulatory side would be concerned a little bit about the systemic portion, not the individual institutions, which can be easily handled by Central One. So you made good points. Thank you for those.
Exactly.
Okay, we'll go back to you. There you go. Thanks.
Okay, great. Yeah. So, I think the approach needs to be structured in a way that it is mutually exhaustive and mutually exclusive and collectively exhaustive. So, what we were showing were essentially the idiosyncratic or the specific risks that an organization faces, but we also need to take into account the systemic risks which can potentially emerge as a result of the second wave, or as a result of food scarcity, or so forth. So with that as a bit of a background to this slide, what we're trying to show here is essentially what are the domestic likely scenarios and global likely scenarios that can really create the second wave, and hence going back to the concept of the W or the zigzag of the recovery. So here we're looking at, again, thinking out loud and very, very specific to the institution, that, folks have started talking more and more about the second wave of COVID-19, as the most likely domestic scenario, and how that would have an impact, again, on the economy and so forth, and the extent of government support which would be available. Some of the other potential scenarios could be, a climate change, real estate crash, or liquidity crisis. So these could be likely scenarios that can emerge. And as we said, this is very, very relevant to each and every institution, cannot really be generalized. Our effort here is to really bring forward some of the thinking and some of the research that we've done and shared with the wider industry. Similarly, on the global side, we already witnessed the oil price crash once, and there's slight recovery in the oil price, but that could be a sustained theme going forward. More and more people are talking about lower oil prices as we move into the next couple of years. Similarly, food scarcity. We talked earlier that large swaths of Africa, parts of South Asia are under attack by locusts, which can really create famine-type situation if not controlled. Regional wars can have an impact, which can essentially escalate and get out of control. Similarly, sovereign default. So although multilateral lending institutions are available supporting the developing and underdeveloped governments, but that being said, this could very well be potentially a scenario that can emerge, where a small country can default, can set in motion a chain reaction leading to bigger defaults and so forth. So from the perspective of a MECE approach, we looked at the vulnerabilities which are institution specific, then vulnerabilities which can primarily be sourced from systemic risks and so forth. So these are extremely important vulnerability type mapping that needs to be done. and then rank ordered on your early warning signal or risk dashboard, and then determine what controls can potentially be made available. So from the perspective of this framework to be implemented, which we are calling an action plan to mitigate stresses, we need to understand the scenario transmission mechanism to understand how it would have an impact on liquidity or other sort of primary loss factors. So as we said earlier, a scenario which is essentially devised using severity and frequency of occurrence would then sort of can be separated into two areas. One is the exposure, so where the exposures are available to identify the relative vulnerabilities, and then once we have the vulnerabilities, we're looking at the control part of it. And then on the severity side, as we said, we need to determine what are the management tactics that are available, should the event risk were to actually materialize. And those are important aspects of it that sort of covers the last part, which we talked about, the management action plan and mitigation strategies to be able to determine how they can prevent the downside risks. Okay. Perfect. So that sort of concludes my discussion. I'll pass it on to Paula for carrying on.
Thank you. Just a question here to help. So in looking at this slide, how can we make sure that we protect our capital? That's part one of the question. Part two is for the organizations that came to this crisis with a very strong capital position, what kind of offensive playbook can they develop?
Mm-hmm, mm-hmm. Yeah, so it's a very interesting question. As I said, some organizations are potentially in a rather enviable position. If they understand the sustainability is not under threat, they can look for acquisition targets. They can also look for, say, internal growth opportunities, or put in place programs and frameworks that would allow them to actually increase cross-selling, focus more on fee-based income, improve the infrastructure with regards to the collection, with regards to the digitization of the lending processes or automation of lending processes. So these infrastructure-related investments will actually create an environment that would sustain them through over the years, because we are now witnessing that more and more organizations are going to be digitizing their activities and their processes, so that the element of human touch or sort of the human to human sort of interaction becomes less and less it becomes more protective and less frequent. So similarly, on the cost side, they have opportunities that they can look at with regards to increasing the operational efficiency. They can look at the efficiency of their points of sale, efficiency of the branch performance, and be able to actually identify steps and measures that they need to take as they move forward. Of course, the role of branch as the hub of distribution is going to become increasingly diminished. So that asset class needs to be reviewed and recommendations need to be identified. In other words, how the distribution can be sustained or even increased using alternative channels. On the balance sheet side, as Andy mentioned at the start, credit spread strategies can be built in. Consumers are increasingly looking at higher yielding investments. So segmentation of the members can be brought into play, where you can have wealth management play its due role, which in most of the cases has been rather subdued. Again, review of the deposits and increasing the term of the liabilities are important ways to sustain the liquidity and to carry it to the next round. Similarly, on the equity side and on the profitability side, consideration needs to be paid to liquidity headroom and to limit the drawdowns and so forth. So there are several opportunities which are essentially available for those organizations that have entered this crisis from the position of strength, and then can continue to actually ride on the wave of strength and come out even stronger.
Thank you. So on the next slide, we're looking at 24, please. So there you go. So any questions, comments from, I think it's Peter's on the line, or any final comments you guys have?
Well, if there's no questions, I'll just jump in and just reiterate what we've said a couple of times already throughout this session. One is that the whole digitalization of our economy has been advanced and accelerated significantly, which is not necessarily a bad thing. I think there's going to be some positives out of this. Healthcare is going to be completely revised and rethought in terms of being able to access healthcare virtually, see a doctor pretty much anytime you need one instead of waiting in a waiting room. So that's going to increase the efficiency. For financial services, I think it's going to mean that there's going to be a lot more efficiency, and therefore, in theory, perhaps while there may be lower spreads for the institutions, the level of sophistication of services and different channels is going to accelerate as well. And of course, finally, at the end of the day, I think once we get through this situation and we figure out better ways to protect our vulnerable citizens and others, I think the society is going to make some changes about what becomes more important to people as opposed to what perhaps has been the case in the past. So I think there are some positives coming out of this. I think it's obviously during this whole pandemic situation, it's hard to see those positives until they manifest themselves. But I think from our perspective, from my perspective, I think there's some opportunities here for managing the risks better going forward and having a sort of a more balanced lifestyle and society. So I think there's some going to be some good things coming out of it, but it's going to be a while before those emerge. Thank you.
Yeah, thank you, Andy. I agree. I think there'll be a few good things coming out of this, and I think also hopefully companies will be more well prepared to take up any other crisis that we're going to go on in this area. Even though we had the 2008 crisis and the tech bubble before that. So we've been through 9/11, we've been through a lot through this, century, since the beginning of the 2000s. But I think there are some very positive things. Sohail, any final words?
Well, thank you so much, Paula and Andy, and my fellow panelists, Andy and Paula, the moderator, and of course, thank you to all the guests for joining us.
Thank you very much. So this concludes this webinar. Thank you.
Thank you.
Thank you.